I think it's nearly 6:30, we'll make a start. I should be a school teacher, shouldn't I? Okay, so good evening and welcome everybody to the London Blockchain and Insurance event for April. And we've got really interesting number of speakers this evening and our panel at the end as well, where we're trying to introduce the world of blockchain to insurance in different ways. So I guess as a starting point, how many people here already know about blockchain and distributed ledger technology? Okay, so maybe I should then ask anyone who doesn't. Great. So that shows a remarkable turnaround in its own right. Because when I asked that question in 2016, the majority of people were going, block what? That's kind of a new word type thing. So it shows how people in the market and technologists really bought into this idea as a concept. And it's great to see that the insurance industry, which is one of the more traditional marketplaces, is looking to adopt this technology and could actually be right at the leading edge, and hopefully with professional input from people, not at the bleeding edge. So hopefully we'll be able to improve and so on. So this evening, the format of the session is that we're going to have a presentation initially from Calogero, I think I've spelled the name right this time, Scibetta from Everledger, who's going to be talking about, not quite blockchain actually, but really the transformation of trust in the 21st century. Then we're going to go on to the main act of the evening, Areiel Wolanow from the London Market Target Operating Model. He's going to be talking about the recently produced white paper that he's done and the work that they're doing about dragging the London commercial insurance market bureau into the 21st century. I think I managed to drag part of it into the 20th century. It's good to see that final edge going on. And after that, we're then going to have a panel, which I'll introduce the people on that as well. So the way I try and run the panel is, rather than me spending all my time asking questions that I want the answers to, I find it much more useful for people in the audience to think about questions as well. The one request I do have, however, is I do find that at some of these events, people turn the question and answer thing into kind of like a personal promotional campaign. So they start talking about, oh, well, I'm working on this, blah, 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 blah. And they throw in the incidental, so what do you think about this type of thing? So what I'll ask to avoid that and to make it interesting for everyone, try and think of your questions in terms of 140 words or less. It's kind of in the spirit of Twitter. Okay? So with that in mind, I think I'm told that there's no emergency practices planned this evening. So if the alarm goes off, it's for real. I would suggest follow someone in a suit, because they'll know where they're going. Or more likely to, and I've got my tie over there, so I'll go for that. So without further ado, I'd like to hand over to Calogero. Thank you.
Hi everyone, thank you. So as Gary said, today I would like to give you more context around why I think and Everledger think that blockchain is actually very interesting, not just as a technology, but actually as a change in culture overall. So if you think about, there are three different stages of trade that I would like to go through, and four major technologies that are impacting the way we do business today. Blockchain is one of those, but what I wanted to highlight is how those technology play a different role combined. Because one of the major problems you see with blockchain is that blockchain is treated as a standalone thing, like blockchain does that, blockchain can do this, blockchain can solve that, but blockchain do not operate in isolation. So it builds up on technology that already exists. So I won't use any slides because I think everyone has seen too many slides in their life, right? Whoever is in the audience, so I'll just try to just stay with me and I'll try to explain. So if you think backwards around trade and the way trade used to work, trade started as a community thing. So the main every community has their own trading, has their own trading rules, have their own trading set, their own tools, and basically the major driver of trust in those communities was the reputation. So everyone knew each other, everyone knows how to trade, so therefore that could be exchanges between parties. You didn't need to have a third-party verification because everyone knows each other, so the crowd, to a certain extent, was the guarantor of the trust in that community. When trade then goes global, you have a different landscape. So trade routes open here and there, markets become bigger, global. So you start to have people who traded that actually had no relationship, no historical relationship. So therefore, you actually needed to have third parties to guarantee, the counterparties, the risk, the effectiveness of that trade. The point I'm trying to make in here is that, in blockchain community in general, the third party is evil. But what I'm trying to say is that the third party was necessary. So the third party responded to a need where untrusted party needs to trade between themselves, and you need to have, third party for currencies, third party for trade, third party for insurance. So third party actually solved a problem. So now, with digital and globalization, of course, trade become global. So you actually have trading that is taken to a level that wasn't unprecedented. You have markets that are disrupting, people who trade who don't know. So you actually have a much faster evolution in the way trade is done. So, you don't even have a relationship based, but you're moving into the transactional layer. So if you think about the last purchase you have, you really start to have more counterparties, more people that trade, more marketplaces. So even from one entity or one individual, you are effectively scattered into multiple. So your digital self, both as an individual, as a company, it's actually, siloed into different platforms and into counterparties. So nobody really have a full picture of your reputation, right? So your reputation on Amazon doesn't match your reputation on Booking, that doesn't match your reputation on PayPal, but effectively you have the same person. So there is no way for you to collide all of that. So when you think about digital trade, when you think about digital trust, what you're seeing is that there is no real way to harmonize all of that into one single place. So if you think about, as I mentioned before, the third parties grew into specific places like the Lloyd's of London. The Lloyd's of London was a place where everyone came, and actually you have third parties from different regions and different groups that actually represent, to a certain extent, other parties. You have guilds that actually were third parties that represent other actors. But because the scale and the distribution of digital is actually 24/7 global, that structure is not sustainable anymore. So you need to have some sort of digital standard for trust. Because at the moment, what you're trying to do is effectively taking the standard that you have for the third party and just digitize it. But it doesn't fit the purpose, right? So e-commerce is 24/7, but banking clearing is 5 days a week, banking hours, right? So it means that you need to change the way you actually operate in terms of practice, in terms of standards, and et cetera, et cetera. So why this is important and why this is important now? So if you think about technology evolution, in this room we've all been young enough, to see the emergence of the web as a main technology, right? So when you think about web, the main benefits of the web technology gave us is the idea that you can access information. Everyone can access information. Information is available. You don't have constraint anymore about physical location where you are, so you can access everything. Because we saw the web, we also saw the smartphones, right? And when you think about the smartphone effectively does one thing, which is it gives you the ability to access information anytime, anywhere. So in a world where information is accessible anytime and everywhere, so you can actually combine that. And this is pretty powerful. And it brought a second wave of technology. Now, of course, we are in the age of AI, and what AI does is effectively you have all the information, and AI can make sense out of it. So you can automate a lot of things, and you can actually build on top of that. So you have a new emergence of models. But the problem with all this data is that all the business that you are building now, all the interaction you have, are based on the principle that the data is not trusted. So the data needs to be verified, that the data is actually sometimes shady. We heard about fraud, scams, fake news, everything now actually is questioned. If you receive a cold email, the first reaction is, who is this person? How does he have my email? How do I know him? Why is he writing to me? So we all effectively operate in a world where data is not trusted. So we spend as an individual, as a company, a tremendous amount of time on verifying data. And you have a lot of intermediaries and other companies. The only reason to be is actually to verify someone else's data. And you realize that when you apply the speed of digital trade and digital commerce into, wait a minute, I have to send this data to be verified before actually can act upon, you are effectively a bottleneck. So Everledger has been working in the diamond industry, for instance. So the diamond industry, probably the most traditional industry in the world. Insurance is fighting with legacy, we are fighting with fax machines. So it's very, very different thing. But effectively, the problem that we'll be tackling is a problem of provenance. So it's the history of something. And the history of something is based on how true and how secure is the data that you can collect to make up that history. So you have to understand that, if you want to trace back the provenance of something, even if it sounds trivial, it's extremely complicated. We have been examples where, you have tens of intermediaries between, a mine and a finger that don't know what is they're actually handling, where this thing come from, where was it made, because you don't really have a trace for that. So what we did with blockchain, and what I think with blockchain is interesting, is that for the first time, you can create a way to have trusted data that can be shared among different people, and those people can actually start to rethink their business. So for me, what is exciting about blockchain is not the technology itself, is that effectively is pushing every industry to rethink themselves, because if you start to trust the data, you actually have new business model, new services, and actually new relationships that you can forge, because today you are restrained by that. So when you think about insurance, and we're here today, underwriting is based on data, claim is based on data, pricing is based on reputation. So today, all those things are scattered, and you spend more time gathering that information that actually process that information and create the output out of that. So what I think that is very interesting about blockchain is not necessarily what it can do or the technology itself, is actually that it will enable everyone to actually change the way we operate as an individual and how you manage your own data as a company and how you operate in that specific. So I think it's a tremendous opportunity for the insurance, because insurance has been a great place for trust, but now trust needs to scale as insurance needs to scale. So therefore, blockchain can be the platform for that. Thank you.
Thank you for putting that very succinctly, and much appreciated as well. We did start a little bit late, so we're trying to kind of play a little bit catch up at the moment on the schedule. But to bring on Areiel now, I always use this escape thing of who needs no introduction, because I'll leave him to introduce himself. So.
Very good. Do we have the other? So, no, do we have the other presentation?
Where is the... what's this?
Right.
This one?
Yep. So, I'm not as capable as Calogero. I do use slides. This is actually the second time we've shared the stage. Calogero and I both spoke at a forum hosted by the ICAW last July on how blockchain is going to impact the audit profession. I started my career many, many years ago as a CPA. But anyway, so my name is Areiel Wolanow. I lead lead a small consulting firm called Finserv Experts. We are currently engaged with the LMTOM program, and you're here because blockchain is the peak of hype curve. It is new, it is cool, it's sexy. But I read a great LinkedIn post, it was late January, that basically said, I am tired of hearing from blockchain experts. or people who say they are. There are no blockchain experts. We are all just figuring this out as we go. I've certainly felt that to be the case, and I've been playing with blockchain in one form or another since 2014. I was with IBM for 11 years. I was the first leader of their blockchain services practice in ASEAN. In that role, I sold and then delivered IBM's first non-research commercial consulting engagement, blockchain, which was a trade finance prototype for HSBC and Bank of America, delivered out of Singapore. Worked with several financial regulators and central banks to help them chart paths for blockchain adoption. And then for my very first foray into the London market, was engaged to work with Richard and Charles. Richard and Charles, please stand up. Richard and Charles are the co-authors of the white paper. So tonight, I'm going to be taking credit for all of their hard work. But no, the three of us worked on this feasibility study together. So when I came to this is my first experience at all working with the London insurance market. So naturally I did some reading, and I read something that was talking about sort of the history of the London market. And what it basically said is the London market is falling behind other insurance delivery vehicles because other insurance are using mathematical algorithms to price their insurance and are increasingly adopting automated methods, while the London market is using processes and ways of working that are many, many years old. That was written in 1870. So it gives you an idea of how long the London market has been dealing with this this kind of resistance to change. So full of fear and panic, I took up this role. So what I'm going to do now is actually remedial, given the number of people who raised their hands said they know blockchain, but I think it's worth doing anyway. In the sense of this is a method that I've been using to explain why distributed ledger is interesting, because ultimately, if the market does decide to adopt the solution that we're putting together, it will not be because it's on blockchain. It'll be because it implements a new business model. And the new business model is what delivers the benefits, not the technology. So most of the people we work with in the market are relatively intelligent, and most of them have heard about blockchain and understand at some level. But I get a lot of questions about about what it does, and so why is this thing called blockchain really worth even thinking about, and how does it help disintermediate the bureau? So I'm going to walk you through how I use a non-insurance example to build an intuitive sense. And my assertion is, if you understand this intuitively, I don't have to tell you the business case. You'll tell me. So this is how I do it. I say, so let's say Gary, that you've got a factory and you're making widgets, so you find a buyer for your widgets, and say I'll pick on Kevin there. Kevin, you've got a factory and you agree to buy some of Gary's widgets. So you guys exchange some information, price of the deal, you negotiate a deal in terms of the contract, how many widgets, you're going to buy 10,000 widgets, you're going to send them in. So you trade information, and you guys have never done any business anymore, so this is very much along the same lines of Calogero's network of trust. So you don't, you want to make sure that Kevin has the ability to pay you if you're going to invest money in building these widgets. So you ask Kevin for a letter of credit. So Kevin goes and talks to his bank and says, I'd like a letter of credit so I can buy the widgets. And does the bank trust Kevin? Of course not. Okay. So Kevin shares some information that yes, I have the cash flow. I will be able to and I've got buyers for the widgets lined up. Does the bank trust Kevin? Of course not. So the bank then goes back and talks to Gary and says, did Kevin really do this deal with you to make the widgets? So you exchange some more information, and then says, okay, so the letter of credit is granted. You do the deal. Now you're ready to make the widgets. Well, you don't have money just lying around to buy all the raw materials, so you need to go to your bank and say, I've just landed an order for 10,000 widgets. I'd like a loan so I can buy the raw materials to build the widgets. And does the bank trust you? Of course they don't. So they now have to go talk to you and Kevin's bank and make sure that all the details of this are true. I'm not making this up. This actually happens. So then Gary builds the widgets and he's got to ship them. So he talks to the shipper and says, I want you to ship the widgets to Kevin. And of course, the same thing. The shipper doesn't trust any of this. They need to make sure that widgets aren't a dual-use munition. They need to make sure that that Kevin will accept the widgets when they arrive, that the widgets are going to get paid for, or they're taking a risk. And of course, the regulator will step in, and they will want to know everything from everybody, since the dawn of time. So what you end up with is a situation like this, where organizations are spending far more money just talking to each other and changing information than they are in their core value chain. Okay, so poor Gary here is spending more money talking to people than he is making widgets. Kevin is spending more time than he is using the widgets, for his business. Now, of course, this kind of problem always is an opportunity to people. So then somebody will come in and say, look, this is expensive, it's inefficient, it's vulnerable. We could help. So somebody comes in and offers to outsource this whole morass and says, we'll take care of that for you. We will handle all of the communications about the widgets that need to be handled. We'll take it off your hands, and you guys can focus back on your value chain. And probably initially they do. But what happens is, these people are doing this to make money. So their motivation is to deliver the minimum possible for the contract, meet their SLAs, get paid. But you end up with a ever-decreasing level of service at an ever-increasing level of cost. Now, this is the point at which, when I'm presenting this to, not only the market, but people in the LMTOM, people are nodding their heads. Okay, so this is the Bureau. This is what we're talking about. So, by this point, people understand, okay, so now I know why we're talking about blockchain. So then I say, okay, so this is how it works. So instead, Gary and Kevin agreed that they are going to, that they are members of, a blockchain-enabled trading network, and they are both going to share a single version that represents this deal that they've done. So when they bring, in the letter of credit has one place to look for the information to be verified. The supply chain financing, the shipping, and the government all have to look to one place. So, so people start to get intuitively the business case, and by this point, quantifying it and putting the dollars in front of it is largely just an exercise in due diligence. People fundamentally get it. So this is how we build up an intuitive understanding of how blockchain and how DLT is actually going to do what we were asked, which is to disintermediate the Bureau. So let's talk about the LMTOM program. So how many people here know what the LMTOM program is and does? Most of you. Okay, so I'm not going to waste too much time on this. They were given a mission to make it easier to do business with the market because of the belief that the gap between the experience of buying and selling insurance through the London market and sort of the leading edge of where the industry state of the art is, that gap is growing and the market risks losing relevancy. They published a blueprint about a year and a half ago. As many reactions to that blueprint as there are market members, if not more so. But one of the reactions was, it's not enough. You're not tackling the big elephant in the middle of the room, which is the Bureau, and it's hard to believe that we can do this if the Bureau continues to exist in its current form. So they commissioned a feasibility study to come in and ask two key exam questions. Could a new and more effective and significantly lower cost operating model, Simon Gaffney wrote this question, by the way, so give credit where it's due, be created for premium and claims processing between brokers and carriers using emerging innovative technologies? And if so, what would the economic case for this adopting this new model is? Now there were dozens of people involved in one form or another, but Richard and Charles and myself basically led this feasibility study. We created a white paper. Getting approval to release the white paper to the public took longer than the feasibility study itself, which those of you who are dealing with the market again are nodding their heads and they get this. But the white paper is now available. You can download it. It's on the LMTOM website and see some of this in more detail than you could possibly care to. So this then is a list of the business services that the Bureau currently performs that if we were successful, we would need to disintermediate. And again, this is not about creating Bureau 2.0. We're talking about a new business model in which there is no central processing capability at all. So there's, all of the processing happens on member-owned nodes. Not just the DLT piece, okay? So the idea is that members would be provisioned nodes in the cloud, okay? And those nodes would have everything they needed to do the job that is currently done by the Bureau. So it's a completely decentralized and disintermediate solution. The only things that remain in the center are a small DevOps team to fix bugs, apply security patches. You don't want to count on the IT department of 400 different market members all applying patches at the right time. As well as obviously some level of functional enhancements. And because this will be a private blockchain for the market members, this central organization would serve as the certificating authority. But that's it. There's no actual central processing. There's no central processing capability in the center. Things here. So claims administration. How readable is this? Can you guys read this? I don't want to parrot slides if they're readable. Okay. So a lot of services around claims agreement, transaction processing, net settlement, regulatory reporting, all disintermediated by a solution. So when we started thinking about this, we didn't start with a system architecture. We said, what does a business model look like? How would this actually work? Okay, so the traditional model is a service provider model, where somebody comes in, and this is a BPO play. So somebody says, we will handle the processing of this business. Okay, so in the service provider model, the driving, overriding imperative is maximize the profit of the service provider. The service provider sees itself, is why the arrows are pointing at the center of the universe. So this is all about, we will satisfy the processing needs to the extent that it is mandated by SLAs in the contract. In my career as a consultant, I've had to deal with plenty of projects that turned red because the service provider saw it as a cash cow and basically committed the minimum level of resource to draw out the most cash. Now I've seen this both from the standpoint of an opportunity where I was invited in to go and replace that service provider, and I've also seen it as sort of a red project where I'm going in and trying to fix the relationship when this has happened. But it's all coming from the same place, is that the motivation is really bound by the terms of the contract. So you say, okay, so we're smarter than that. What we'll do is we will form the members of the market, and again, this is not just insurance, this is anything. We'll form a co-op, where the co-op is actually owned by the people who benefit. So you're guaranteed a certain level of strategic alignment. Okay, so now you have a center, but its goal is to take care of the members. So it actually cares about the members. The members are funding this organization. So Lloyd's itself is a co-op, Swift is a co-op, MasterCard is a co-op. So there are many successful co-ops. So this at least takes care of the problem of alignment of goals. Okay, and that's not a small thing, but there are still some problems with the co-op model. And the co-op, you say you give somebody a hammer and all they see is nails. The co-op still sees itself as the solution to the universe. Okay, so despite the fact that they joined R3, Swift finds it very hard to envision and to support a model that disintermediates Swift, that does away with the need to have Swift. And instead we'll put forward solutions where Swift will be at the center of the next. I did some consulting for a company called Giori, which a lot of people haven't heard of. Giori is a Swiss manufacturer. They make the very specialized intaglio printing presses that are responsible for creating about 85% of the world's paper currency. So almost all of the printing presses that print currency in the world are made by this one company based out of Switzerland. And they're trying to think about how they can survive in a new world, and are actually running a pilot of a digital currency project in Uruguay. But that's rare. Most co-ops find it hard to envision a life without the co-op. So again, there's this organizational desire, which is human and utterly predictable, to perpetuate itself. So we really needed to think about a truly distributed model, a model with no center, okay, with no organization who's trying to justify its existence, where the actual onus to change is actually on the members themselves. So that this organization will only grow in cost or scope when the members need it to. The hard part, so when I think about service providers and I think about co-ops, I can provide many examples from case studies, both recent and in history. When I was trying to find sort of examples of distributed organizations, very hard, because it's not a model historically that's been possible to implement. The one example I could come up with, pre-blockchain, was GitHub. Okay, when you go to GitHub, for those of you who don't know, is a portal for open source software projects. And when you go, you log in, and it's like a GitHub site, and you can download the open source software you want. But it's not actually one site. Everybody who wants to participate actually hosts their own GitHub content. It looks to the user like a single GitHub site with all these projects on it, but it's actually fully distributed. There's no central GitHub server that's serving up all of this content. But that was the only example that Charles or Richard and I could think of when we were thinking of case studies around this. So it is new, and it's now possible largely because of DLT. It allows us to start thinking about these models in an entirely different way. So this is really, and then we did sort of a comparison about what are the overriding objectives, the degree of market control. So here with a service provider, you can only change the way the service provider forms by changing the mandate of the contract. So the degree of control is low. With a co-op, you have strategic direction and oversight, but there's still an immense amount of inertia. Try telling MasterCard, a bank, think about a bank trying to tell MasterCard how to change its processing rules. It's very difficult. Okay. Truly distributed, the community are the only people actually calling the shots, so they have a much higher degree of control. Tendency for central infrastructure growth with a service provider, it's extensive. It grows to justify the cost model. The more they grow, the more they can charge. Very straightforward. The higher quality ones will try to deliver some value in exchange for that growth, but that's certainly not universally true. Here, co-op is still extensive because it grows to justify the existence of co-op. Minimal with a truly distributed because it only grows when people need it to grow. Cost of ownership trend, obviously. You can see impact from new market entrants. Okay, so if you have a service, you have a service provider, and they're providing, their contract that says we will provide this service for 400 market members, and you want to bring 401, or you want to open up a center in Singapore or a center in Brussels. So okay, well that's a change, and there will be new transaction fees and so on and so forth. Here, with a truly distributed model, you just you spin up a new node. So the cost of changing the composition of the market or providing more service is better. Degree of market consensus required. This is probably the one area where a truly distributed model is bad or is worse. Okay, so here, if you've got a service model, you can, with some level of executive authority, say, okay, we're going to change this. Here, you've got to get a reasonable amount of consensus to change it. So it's one place where a distributed model does less well. Implementation risk. Here, it's obviously higher because we're dealing with a new technology. So no question about that. Operational risk, however, is much lower. So one of the problems with the Bureau is there is an ever-decreasing level of expertise. All of the people who were there and had actually a pretty high level of confidence and expertise, they're retiring or they're moving on. And the Bureau is finding it very hard. They're hemorrhaging people right now. They're finding it very hard to keep the level of knowledge that made all these manual processes work. Okay, and it wasn't, the Bureau is expensive, but at least historically speaking, it did its job because they had people who really understood the market. That is becoming less and less true. Okay, so if you can automate and distribute this to where the members actually have a lot more control of what's going on in their own nodes, you're going to get a lot. Your error rate is going to be a lot lower. We think that we can get rid of at least 90% of the queries that the Bureau currently issues. just by distributing and automating these processes. So a detailed walkthrough of how it works then. So right now, brokers and lead carriers and followers all interact with a set of bureau systems. These are mostly green screen mainframe systems. And there's a lot of reconciliation. There's no one single record of the truth. Every member of the market has their own ledger, their own view of the market transactions, different ways of tracking them, different ways of controlling the workflow or the process through claims agreement or transaction accounting. And the bureau is responsible to keep them all in sync. Okay. And in this distributed model, there will be a single shared ledger of all market transactions for both claims agreement and for transaction accounting. So there is no reconciliation required. There's no matching required. It's, it's all there. So the number, so not only is it faster and more transparent, but the number of queries, the number of errors should go way down. Is this all making sense? Am I sort of going at the right speed? Okay. Richard, Charles, you want to add anything to this? All right, so what's in scope? What do we actually look at? We looked at insurance transaction accounting and financial accounting flowing through to net settlement. Looked at claims starting with first notification of lost all the way through the claims agreement process, including a level of transparency not currently available, where the insured can actually say, what is the status of my claim? That's actually a very hard question to answer right now. Okay. Part of that is just syndicated risk. If you've got a number of followers, that complexity is usually shielded by the broker. He says, I've got you covered. But ultimately, you'd like to, the claimant would like to understand what the status of the claim is. If it's going to take, as is the average in some lines of business, 900 days. Okay, that's not great, but at least if somebody knows, they can plan accordingly for when that claim is going to get paid. Then finally, obviously, there's a responsibility to report some regulatory. So that's placement is not part of this. So this is all post-placement. There is a PPL project that's looking at modernizing placement. They are having some success and some challenges in adoption, as you'd expect. It does include transaction accounting support for delegated authority and prompt treaty as another input into it. So it does handle all of the complexity around the different lines of business with fully syndicated risk. And it should handle all of the reinsurance use cases as well. All right, so I don't want to call this an architecture, it's a solution component map, and it was done very early on. The only thing I can guarantee about this is that it's wrong. But it's a starting point, and it facilitated a conversation with some of the more technical market members about how this might work. So the idea is that you would have an operating node that lived in the cloud that was, and those nodes were owned by the members, but provisioned by this certificating authority. So a new member joins, and we say, we'd like to spin up a node, and we create the node for you. But the node doesn't just include DLT. It has a lot of other pieces. Many of the markets have made a lot of investment in, both in terms of business process and in terms of technology, supporting certain standards. So in the case of transaction accounting, that would be accord messages and the Rush-Lacan process. So we don't want to leave, we want to protect that investment. Our job is to help the market members. So we will have full support for, sort of a service layer that supports Rush-Lacan, possibly with a workflow manager to facilitate that, and a message management gateway that allows, market, the IT systems of members to communicate. There's no messaging needed inside here. That goes away. We've got a single ledger. But to communicate to the outside, we'll still need some messaging capability. Obviously, we want to be able to expose via public APIs the native services. So all of the capabilities will be accessible directly via an API for people who want to go faster than Rush-Lacan enables you to do. And because the market has a very, the set of market members is very heterogeneous, there are still single person brokers who are market members. We also need every single capability exposed via a UI, so people can can input transactions directly into via a website or a mobile app where appropriate. All of this needs to integrate with a settlement solution. The settlement needs to support both Lloyd's and company business. So obviously Lloyd's settlements goes through STSO. That's a huge value add that Lloyd's provides. The settlement is backed by a central fund, so you make sure it happens. On the company side, there is no central fund, so if an individual member fails to make a payment, you have to rerun the entire settlement again with that member out of the equation in order to make the settlement run. So we need a settlement manager that supports both kinds. Also, an increasing desire from members, both brokers and carriers, to flag some transactions for direct settlement. So not to be netted, but just to be paid right out to the payee. So we need to support some fairly sophisticated and modern requirements around that. So we'll obviously have transaction services that model all of the transactions, supporting the public APIs. Query services, we'll have to have a query data manager. Very, very heterogeneous data environment. We've got the ledger itself. Then we've got the sort of things that distributed ledgers are bad at storing, but are common particularly in claims. Photos and videos and media files of various sorts. We have information that we can't store on ledger because of GDPR. There's right to be forgotten. So if you were to store any identifying customer data, you can't store it on the ledger because the ledger is immutable. You have to store a link to it and have the actual information off. Now the ledger should be the only place you can get the link, so you still get all the the protection and the data visibility rules around the solution, but you can't store it on there. We need to keep read-only caches of all of the open contracts and claims that are currently in the bureau, because claims can be made 30 or 40 years after, as anyone's been in the market is fully aware of. So we need read-only caches of previous data for long-tail claims. And then finally, because ledgers, at least the current generation of distributed ledgers, are not very well optimized for queries, we'll need to keep a cache for acceptable query response time. So if somebody comes and makes a first notification of loss against a claim, the initial retrieval might take a long time, but if we keep a copy of it in cache at that point, for the rest of the 90 or 180 or however long the claim is actively worked on, you should be able to get a rapid response. So we'll have an identity monitor. So these are fairly straightforward. A smart contract which handles some of the state model, if you will. Some consensus algorithm. Consensus here will include not only this sort of traditional blockchain consensus, almost certainly not proof of work. This is a private blockchain, but we'll have some notion of consensus-driven right to transact. But there's another piece of consensus here which is validated the content, which will be limited to only the parties that are actually participating in the contract who partake. So there's really two parts of the consensus model here. As I said, off-ledger blob storage, a DevOps service, and some reporting. So that's an initial view of how we're thinking about the solution. This will almost certainly morph over time. And then the last thing before we go to Q&A is just the idea of data visibility as we think about it. And this is, this is independent of what kind of DLT. So we did a technical evaluation as well of DLT platforms, shortlisted two and we'll accept either in terms of solutions. The two we shortlisted are Hyperledger and Corda. Obviously have very different ways of implementing data visibility. So this is just a usage pattern. It's not a technical implementation. But we have an idea that an individual user or an automated process can be a member of one or more organizations. If you think about a loss adjuster, he might work for 5, 6, 7 different carriers. Okay? At any time, he's only representing one carrier. Okay? Likewise, an individual person may have the skills or the qualifications to perform a number of different job roles, but at any time, they're only performing one role. So the access to the data, so the data by default is encrypted and not visible by anyone. The keys to unlock visibility to a given cell of data is obtained by an intersection of role and org. Okay? This is actually very important because nobody wants to enable cross-market access. Okay? This is a way of preventing, it's not only a way of enforcing the right level of security, but they also don't want regulators doing fishing expeditions. So if a regulator wants to look at some broad base, they may have to issue 400 different subpoenas to get the records. And they can, that's fine, but they have to be specific about the data that they're asking for. They can't just go in and do a broad-based query. And all of the queries like that would themselves be recorded on the ledger so you could see who was looking at what with the agreement. So that's sort of the CAN vision. Last thing I'll do is tell you where we are in the process now, and then I'll open it up for questions. So with this radical of a business model, we had to think long and hard about how we define requirements. So if you're doing requirements in a traditional waterfall methodology, you would hold a joint design workshop and you would bring in people with the SMEs with the appropriate views and voices, and you would workshop up a requirement spec of some kind. If you were doing this in one of the agile disciplines, you would come up with a list of story cards or a product backlog. Okay, none of those are going to work because, as I said, case studies around distributed business models are not thick on the ground, and people don't have a lot of practice. We came to the conclusion it would be a much better way to go about this, to actually build a prototype, put it in people's hands, and say, can you envision working with this? What would work about this? What doesn't work about this? Do it as an iPad app rather than as a website, so we could put it in people's hands, because research has shown that people engage much more emotionally, and they get more involved if you put something physical in their hands than if you just send them an email and say, here, go to this website and tell me what you think. So in that sense, the prototype is just a design tool, okay? It is not the first step of a production solution like prototypes so often are. In fact, because there are no NFRs, no non-functional requirements, we are specifically enjoined. We may not promote any of the prototype code into production. So it is only a design tool. We've shortlisted a number of solution providers who are going to participate in that prototype, and they're each going to build their own, and at the end we'll select one or maybe more than one that we will use as the basis. Completely separate, when we get to the point when we're ready to do an MVP pilot in production, we'll do a full legal tender. So this is really, so we're right now writing all of the design for the prototype. That's where we are. So we will do that prototype. We will select the best ones to use and engage with the market members with that prototype to do a formal requirements definition, and that will form the basis for going to MVP pilot and production. Right. Questions? Comments? Anybody? Yep.
One of the earlier slide.
Okay. This one?
Yeah.
Okay.
That message management gateway.
Yep.
Will it allow members to continue to use the existing messaging mechanism?
That's the idea. It's to protect the market, the market's investment in that. It's called TML, for those of you who are familiar with the market. We don't want to undermine investment, whether it's in supporting Rush Lacan or even the messaging around ECF. Obviously, we will be replacing ECF, we'll be replacing class, but we hope to basically protect the investment that market members have made in existing APIs, where possible.
So you're talking about USM, SCM, and those messages?
USMs are going away. There are no USMs.
They're replaced by the bot and ECOD.
Yeah, that's right.
Yeah. But that is being replaced at the broker end. At the carrier end, they are not getting replaced?
Yes, they are. No, that will be replaced. But there's a messaging framework, at a technology level that people are using to pass messages. We don't want to tell people they have to implement a new messaging framework to the extent that we can support it. Richard, do you want to talk more about this?
No, I think that's the point. Is
Okay.
That the database, a discrete database, gives you the ability to extract whatever
Yep.
and the APIs associated.
Anybody else? Other questions? Yeah.
How do Exchange and DXC feel about this?
To quote the Facebook relationship status, it's complicated. DXC, I think they understand that that life as usual cannot continue. And DXC is not just exchanging; it's not just the bureau. They're a large system integrator. The more enlightened people in there would like to think that they can take the market expertise they do have and be considered a viable competitor to implement this new solution. Perhaps the more interesting conflict actually comes from the associations, who get some of their funding from the current joint venture. Now, when we put together the business case for this, we assumed that the associations would still get their funding. So we took the amount of funding and credited it, so that we're not trying to rob the associations of their bacon. But the funding mechanism comes from the bureau right now, and I don't think that there's a full realization. So I think there's a lot of fear operating. So like I said, it's complicated. I think that we're getting a lot of different reactions, even within one organization. I'm sorry. I'll get you next. Go ahead.
Seems like to me, in your presentation, at the core is the smart contract component, especially from an automation perspective,
Mm-hmm.
right? What's your view, or I know it's probably too early, but from a prototyping perspective,
Mm-hmm.
is that leading you to one type of technology, whether whether that's Ethereum or?
Well, okay, so we did an evaluation of DLT platforms, and we chose two. We shortlisted two, which are Hyperledger and Corda. We actually removed Ethereum because we don't think they have the ability to support it and provide enterprise support. I know they've announced the Enterprise Ethereum Alliance, but we saw more smoke and mirrors than real substance there. We are fully aware that every major breach and problem that DLT has had so far has not been from the blockchain itself, but from loopholes and faulty implementation of smart contracts. So we are obviously and we're dealing with by nature a very risk averse.
This is going to be private though, right?
Yes, it is. But we're dealing with a very risk averse organization. So we obviously don't want to expose the market members to some of the risks that we've seen through some of the failed ICOs and the DAO hack, et cetera, et cetera. On the other hand, as you say, smart contract is really going to be a key part of removing the need for reconciliation. So we're not going to avoid it entirely. All I can say is that as we design the solution, we'll have to use it judiciously. Does that answer the question?
Yeah.
Right.
You're envisaging a closed garden here for the members of the London market. How do you see it plugging into other systems like D3I?
So the ledger is a shared ledger between the members of the market. We do envision that that this solution, as I said, UI is core to it. Parts of that UI we would like to expose beyond the market, particularly around claims, so that people can see where the hell is my claim and when is it going to get paid. So there are parts of this that will be exposed, but we would expect only market members to own nodes because it's their ledger. It's not the ledger of the insurer, the policyholder, or the claimant. It's the ledger of the brokers and the carriers. But to the extent that it improves the end customer experience, which after all is the whole point here, we will expose parts of it beyond.
But the way I understood this question is
Sorry, I was going to suggest, because we're running a little
Okay.
bit late, we can just hold that off. We're just going to switch into the panel mode. If it's
Okay.
something that you think is going to be of value, let's reintroduce
So it's
it.
just about this point. I think it's the interoperability
Yes.
with other platforms.
Well, so interoperability with the member IT systems, as I said, is really core because we need to protect their investments. So if a critical mass have invested in something like a Cord or Rusticon or even ECF, God help us, we'll support that and protect that investment so that they can use their existing APIs. Beyond that, we will expose the public APIs of the solution itself.
Thank you. Right, I think a round of applause is one Okay, so what we're going to do now, we're going to have a panel. So I'm going to reintroduce Calogero to come back up, and also Lee Bacon from Clyde&Co, and Ian Blackshire, who's a compliance analyst at Cathedral. So we've got a nice blend of technology people and insurance people. I'd like to actually begin, because one of the things that Areiel didn't mention, but he alluded to, so I'm not going to ask him the question on this, is around timescales. Because who actually works in London markets? Okay, because when I was working on an earlier phase of the project, it's a company called Lemonade, who suddenly announced that they'd handled a claim in, I think it was 7 seconds. And I was tasked with finding out how long it takes the London market to process a claim. I said, I don't know, but I don't think it involves a stopwatch, I think it involves a calendar. And it turns out, I think the longest lasting claim is currently over 20 years old and still hasn't been validated. So what was I actually going to pitch is, given that we have a representative here from Everledger, who I keep describing as the poster child of blockchain, because they keep pushing boundaries and moving on. You know, in this market, how can we actually accelerate the pace of the adoption of this type of technology? Because you've worked with a number of large organisations and regulators now. Do you have any initial thoughts around that?
I mean, I think that the key in the industries where we're in is that we didn't come to this industry where we are in, so diamond, gemstones, etc., with this new technology and say we believe that this will solve a problem. Actually, we had a very deep understanding around what were the challenges in those industries, and I think that the participants of that industry had a clear sense of urgencies as well. So I think that the adoption is probably easier now than it was 3 years ago when we started, because clearly, there is way too many blockchain experts. Blockchain is now being discussed everywhere. I think that in any organization, you at least had the conversations. So I think it's really focusing on what are the real problems you're trying to solve, not just to say there is a new shiny thing, we could use it. So, in the presentation, really clearly, there are ambition to say, we can completely rethink the Lloyd's market out of it, but, you have to take it step by step, and understanding that the adoption will be hard, and also that the technology is very new as well. So you have like this double complexity where you need to understand that the technology has the promise to be transformative, but you also have to understand its stage of maturity. So I think we did this right. So understand a real problem and understanding the complexity of an emerging technology, because applying emerging technology is very different than applying a mature technology.
So maybe if we introduce Ian at this stage, with him being a representative effectively of an underwriter within this market, what's the kind of thinking from the sharp end at the moment about this?
I think, like we were saying, like the word blockchain and that's being bounced around now the market. I think for the last 12 months we've seen quite an uplift in invites to demos, etc. But there's still, I think, like especially from say like leadership structure at the top, it's still that, well, is this going to be wholesale change for our systems and all of that? So I think it's about educating the major stakeholders within the business, and really where you can sort of apply it on like almost like a granular case, rather than like the bureau idea is fantastic, but that's to sort of majorly change the market, where if we applied it into something which you could see a managing agent getting a direct benefit from with an internal process, I think that's where then the buying will happen, and then stakeholders will then start looking at these bigger sort of market solutions.
Yeah, that's good. So, Areiel, just coming back to you then, because in the paper it describes a kind of broad time scale, which I think it's somewhere between 2 and 5 years for adoption.
Well, okay, so, so the paper does not mention any specific times, and that's intentional. That doesn't mean we don't have opinions, but they aren't informed opinions, because the decisions that we need to make haven't been made yet, and they're not going to be made by me or by Richard or by Charles. They're going to be made by the members of the market. You could posit that it might take 11 months, 22 months, whatever, to build a solution that was production ready. But that is only the point at which adoption can start. And if we look at adoption of CSRP or PPL or SDC or any of the other large LMTOM programs, you can see that adoption is not something that happens quickly. And LMTOM is arguably far more successful for all of its troubles than any of the previous attempts to do the same thing. So this is not, the adoption challenge is not one that we take lightly. Also, we have the fact that the market announced a 5-year extension of the DXC contract. So there's going to be some limitations on how much adoption. We couldn't envision full adoption until we reach the end of that 5-year period anyway. So it does give us some leeway and some room to say, okay, we can build a solution and then have a staged adoption over a certain amount of time. The goal certainly would be to be ready for full adoption by the time that 5-year contract expired.
Okay. So talking contracts, that probably links quite nicely with the legal side of things, honestly. In a smart contract-enabled world, is anything actually any different from a legal perspective?
It's interesting. I was sat here looking at the charts as the market and how it will change, and I felt a bit like, I'm going to use a football analogy, Wayne Rooney in a Man United dressing room last season, kind of they're talking about tactics and how the team's going to work, who's going to play where. He sat there thinking, what about me? Where's my role? And the truth is, his role was pretty limited. Now, we love, as a law firm, frankly, we love, and we've made a lot of money out of, historically, that mediation in the market, letters of credit. So actually, there's a fundamental change here. But within that, there are some core issues about transfer of risk and responsibility that need to be kind of factored into that process, both in the process and the individual level. I don't want to get bogged down into, what's a smart contract, when is it, or is it not a smart contract? But nobody actually wants to enter into a contract, as you were saying. You want to transact, I think it was your point. Parties want to transact with one another. They've had to build the layer, the contracts on top of that to enable them to do that.
Absolutely.
If this system works as it should do, a lot of that kind of the contractual regime can be superseded or taken away.
I think there's a parallel between the legal profession and the accounting profession. As I said, Calogero and I spoke at the ICAEW last year, and one of the key messages that we had for the auditors was your job to so the questions you need to ask as an auditor don't change. The level of surety you need to provide as an auditor doesn't change. The methods by which you go about answering those questions will change a lot. And I think the same is true of the legal profession. The level of surety and the level of support that will stand up in a court of law around these agreements and these deals doesn't change. What changes is how the lawyers will do their jobs and the interaction points that they will need to make.
And if we can build the insurance itself overall, right? So, the underwriting function will be here, the claim processing will be here. What actually changes, the way it's the governance around the function rather than actually the function itself. What does it mean, to process a claim, when your competitor is 7 seconds and where, you have that complexity, but, customer will still have claims, right? So the fundamental do not change. What change is the environment in which you operate. So, you will still have, legal requirements. You will still need to have, every party that transacts will still need to have enough assurity and comfort in order to transact. But the way that is manifested is completely different.
It's the unpicking that's interesting. I think that's what's really drawn me to this, unpicking what you've done before and putting it in this new context. So we just talked about endorsements was one of the few things on the slides that was straight to us. There's oodles of case law under English law as to how you treat an endorsement, offer and acceptance. That will all have to be applied, but just to a different framework.
Yeah. During the, right after the DAO hack, where somebody exploited a loophole in a smart contract to steal $50 million from this distributed venture fund, the thief did a Q&A session over Tor, over the dark web. And his assertion was that he didn't break the law. He said, "This is the contract. I found a provision in the contract that allowed me to take this money, and it's mine." Now that didn't receive a very sympathetic response, and in fact, the governance of Ethereum decided to hard fork, and back that out. But a lot of people weren't happy with that decision. A lot of people who are avid fans said, as much as it hurts, and even though I'm an investor in DAO, I don't want that hard fork, because to me, now this is an ideological view, and of course there were a lot of ideologues involved in DAO. But I think, while it I don't think it went anywhere, the assertion that somebody who exploits a smart contract exploit hasn't broken the law is a perspective we need to reflect on.
I think it's wrong. He didn't break the code, but I'm pretty sure he broke the law.
Okay, so let's kind of extend on that a little bit further, because you mentioned kind of thing about the Ethereum Foundation. They made a decision to actually hard fork, which from a personal basis I thought was really, really interesting, because it completely disproved the process of consensus. So it was an experiment that kind of proved it. But one of the things on Areiel's slide, and Ian, I'm actually going to direct this to you to begin with, is that Areiel made the assertion that in a distributed world, the degree of market consensus for change is high. Now,
this is an alarm bell straight away.
Because it's beginning to sound like we're going to replace an elephant with a decentralized elephant.
Where that's what I was thinking on there. You're going to have a lot of parties saying, "Oh, I want this change or that change," but I think everyone's working to achieve that same end result, if that's for your data integrity, if that's for reporting regulatory purposes. So I think the sort of changes you're sort of coming onto wasn't more about, I want it looking like this, or a structure. It's about more the actual concept of flow.
Well, I think it's a valid point, and I think I would view, anyway, the conservatism that is inherent in that to be a good thing, because basically the only time the market will have to spend money is when the business case for making it is such a no-brainer that the members of the market agree. And that's, to my mind, that's actually how it should be.
It's almost like when you see a new regulatory requirement will come in where you'll be required to report on this or that. That's the sort of change I think what you want to make. So it became, okay, we need to look at, say, for example, we need to report on tax now. Okay, we do it already, but you would add that in. The participants there will reach that consensus, and you almost build it to spec for them, which will satisfy every subscriber on that chain then. So.
Exactly. Yeah. And like I said, I would assert that's how it should be.
So I'll ask one last question, and we'll open it up for the audience. This is for anyone on the panel, really. Because a lot of the sponsorship at the moment around this is around LMTOM, which the kind of clue is in the London market, target operating model. If you have a truly decentralised peer-to-peer environment, where does London come into play?
Well, I'll go first, but the answer to your question is absolutely. Now, we weren't allowed to put this in the business case for obvious reasons, but one assertion is that there's actually, apart from the cost savings and the increased customer satisfaction, there's a revenue driver with this solution. Because if it works, there would be nothing to prevent the 400 members of this market from spinning up a center in Brussels, a center in Singapore, even a center in China. With this solution to the benefit of the members who paid for it. So absolutely. Now I can't go, like I said, I couldn't quantify that, I couldn't put it in the business case, but it is certainly something that the members are aware of, that potential exists.
But then I still think going on that you would still need that sort of market presence, which is Lloyd's, because that's what's that global reputation. You've got the global licenses which enable you to trade your insurance business. So whether that's a fictional London in the cloud, you still need that Lloyd's brand there to keep the market moving, I believe so.
So I guess that's the thing that you described, like a central model and distributed model. You didn't kind of describe a franchise model. Is that something for the future?
I could think of, just off the top of my head, 5 different ways of federating a solution, if you will. Like I said, I joined the market to do this project. I'm a banker by trade. I'm not going to sit here and say I have the right answer for which model would work.
That's cool. Okay. So maybe the people to answer that are the people who are in the market.
I would say so.
So that's a cue to ask people if you have any questions for the panel. Stunned into silence. You're still at the point of going email, e-cop, e-bot. Tom, go for it.
So Areiel, let me be a bit of a devil's advocate. Because
Please.
So you said with Everledger, okay, that's got a really, really specific focused purpose, right?
Mm-hmm.
And cryptocurrencies, again, they've got a very specific focused purpose.
Mm-hmm.
So are we actually biting off more than we can chew by looking at this big, complicated ecosystem, like how Lloyd's transacts, subscription market business, and trying to tackle that in the same way that Everledger has done it, or other more focused, let me put it that way, things have done it?
Well, first of all, I would challenge your assertion about the use case of cryptocurrency, but leave that apart for a moment. I think it's a good question to ask, but after 9+ months of working on it, I would say no. The surprising thing is, relatively speaking, how much this reduces the complexity. So Charles, here's our business architect, and I may ask him to comment after I've done, but I'm looking at the he was just showing me a current state, just this morning, current state model of how claims agreement happens. And I was comparing that to the model that has already been through a fair level of scrutiny and argument about how we propose it. And it seems to me like our model is simpler. Charles, you want to say anything about that?
Well, most of the things we're looking at the moment are the common services that they all do. We do a global business. And a lot of the legacy systems force the business market participants down certain routes and down these tunnels. Using a distributed model, we had to break that open, and you can see when you're transacting, if you have, how would I describe it? You owe me some money. We have a common invoice. It's just invoicing the money. So if we have a common ledger, we don't need to start invoicing each other every 5 minutes. We actually can see the transactions open out in the market. Currently today, you have a USM going that way, VSM flying the other way, and in claims you have SCMs flying the other way, and you get confused. There's a lot of unallocated cash in the market. So I've lost my train of thought. But as you can see, there's some common things that we can use out there, and that's what we're going to use blockchain for. Can we replace the entire insurance market? No, we can't. We're not venturing into the underwriting side of things right there. We used to have the underwriters to do that part as well. So we're just looking at transaction accounting and also the claim side where there's a commonality there as well.
I'm going to add one if I can.
Yep, please.
The complicated stuff in the London market is about the product, the way you distribute the product, how they use the world. We're not trying to solve that. The difficult thing in claims is not about the backwards and forwards process between a broker and a carrier and even insured. That's just a process. That's I talk to you, you talk to me, and we agree or we disagree, and we carry on negotiating. That's the process of blockchain. Complicated bit in claims is all about negotiating the loss to the end participant and what the value of that is, especially if you're dealing with something that's £100 million. And whether or not it's a loss or it's actually I haven't got something for a period of time, that's where the 900 days, or 20 years, because people are talking about that. They're not process bound in that. The bit that is actually really simple in the London market, but is at the moment looks really complicated because of the legacy we've got around it, are actually just those operational processes. If I send you something, you agree or disagree with it, we talk about it, and we update that information. That's not very complicated. And when you boil it down to the process flows, it's pretty simple actually. We just make it really difficult.
And like I said, I'm continually surprised that there's less, there's less complexity than, as a new entrant in the market myself, that I would have expected.
I think the complexity has been introduced over the years, and that's where blockchain, and it gives you a good excuse to do a process re-engineering exercise. Even if you end up not using blockchain at the end of it, you've moved forward.
Pratap, you had a question?
Yeah. To what extent is this taking the current process and blockchainizing it? Because if we are focusing only on reducing cost as an objective, or are we adding some value? Is there some new kind of processing that we can do which can add value to the work done in, to the products that we can sell, or the settlement mechanisms, or the various settlement structures that we can support?
If-
Is there any value added in those?
If we end up re-engineering tomorrow's bureau today, we will have failed utterly, and I will retire in shame. No, that we are absolutely looking at, coming back to it, this is why we're prototyping, okay? Because if we went into a joint design session, or a story planning session, or a product backlog session, we would do exactly what you're talking about. That's what happens. So what we're trying to do is create a prototype that actually helps people think about the processes in a completely new way. So, and the market members do support us on this. The people in the working groups, they understand this is a greenfield attempt to write a new process for agreeing a claim, a new process for settling debts for both premium and claims, a new process for net settlement. So this is absolutely not re-engineering the current process flow. We need to do a reality check against the current capabilities, because we need to provide every capability that is currently provided by the Bureau in terms of settling market transactions. But if we do it in the same way, and if we start with this process model, we have failed before we begin.
Okay, with that in mind, and given the time, can we have one more question?
No, it's interesting the sort of the vision of as this gentleman put it, that closed garden approach and the comparison with GitHub.
Mm-hmm.
And one of the beauties of GitHub is the fork,
Yep.
allowing
Anyone can spin one up. Yep.
parties at scale to gather and collaborate around the problem
Mm-hmm.
and solve it. Whereas I didn't see that coming from this proposition as much.
Well,
I was wondering how you approach solving tomorrow's problems at scale through innovation.
Well, so the market is a closed membership. It is the best. When I'm explaining the market, or indeed Lloyd's, to somebody who doesn't understand it, who thinks that Lloyd's is a company, he says the best analog of Lloyd's is not AXA, it's NASDAQ. Lloyd's is a market, and to trade on that market, you need to be a member of it. You need to have a seat on the market. We're not being asked to change that fundamental aspect of the model. Now, it's pretty easy for those of us who are professional disruptors of one kind or another to see where you could go with that. So it should make it easy for this market to operate out of Singapore or Brussels or somewhere else. So I can understand that, and I'm sure Ian and other carriers can understand that as well. So we don't want to be blind to that possibility, but that certainly wasn't the remit we were given in the feasibility side.
Richard, were you keen to add an additional comment on that?
Sorry, it was just a really simple question to Areiel. Is where can we find the white paper?
It's on. Thank you. Yes, the white paper is available on the LMTOM website. So if you just if you just Google LMTOM, you'll be taken to their site. You have to root a bit. There was not a big public fanfare, and that's because of the level of resistance. But it is out there. It can be downloaded, or if you can't find it, connect with me on LinkedIn, and I'll send you a link to the white paper.
So in fact, you'll also find it on the London Blockchain Insurance event notice for tonight.
Okay.
There is actually a link on there as well. Okay.
Thank you.
Sorry to have to close this off. We're running a bit tightly to time. But if I could just close by, on behalf of London Blockchain Insurance, thanking Clyde&Co for hosting this event tonight and providing the nibbles and the drink as well. And to everybody on the panel for participating, and for Areiel and Calogero for presenting. So please join me in thanking them.